On Monday, April 28, 2026, at a podium in Ottawa, Mark Carney announced something that no Canadian Prime Minister has ever done before. He did not announce a tax cut. He did not announce a budget line. He announced that Canada would become a shareholder in its own future, and that you, personally, would have the option to buy in. The Canada Strong Fund, $25 billion, a sovereign wealth fund, Canada's first. And the silence from most of the media tells you everything. Because here is what is actually happening. While headlines focused on the deficit number in Tuesday's spring economic update, $66.9 billion, down from the $78.3 billion originally projected, the structural shift buried underneath that number is the one that will matter to your children far more than this year's fiscal score. Canada is not just spending. Canada is, for the first time in its history, building a machine designed to compound national wealth across generations. And the people who stand to lose the most from that machine working are already working overtime to convince you it's a scam. Think about what that means for a working family in Windsor, Ontario. A machinist, 2 kids, a mortgage locked in at 5.4%. Every dollar she sends to Ottawa this year feels like it disappears into a hole. That family is the person we are talking about for the next 15 minutes. Because this announcement either means something real for her or it doesn't. And the answer to that question depends entirely on whether you understand what Carney actually built and what he didn't say out loud. We know what Carney announced because the government backgrounder is public. We know the initial endowment is $25 billion deployed over 3 years on a cash basis. We know it will operate at arm's length from government, a new Crown corporation, an independent CEO, an independent board, modeled explicitly on how the Canada Pension Plan Investment Board operates. We know the fund will take equity positions in projects, not just hand out loans. That distinction matters enormously, and almost nobody in the press gallery explained why. We know that a retail investment product is coming, meaning ordinary Canadians will be able to invest their own savings directly into the same fund. We know that Finance Minister François-Philippe Champagne confirmed the $25 billion will not appear as a traditional line item deficit expense because of how accrual accounting treats equity investments. We know that the spring economic update itself projects a deficit declining to $53.2 billion by 2030-31. And we know that the Assembly of First Nations issued a statement the very next day saying the fund's consultation process has left Indigenous communities without clarity on how they will participate. That statement landed with almost no coverage. File that away. Picture the room where this was conceived. Not the press conference, the room before that. Mark Carney is not a politician who stumbled into economics. He is a former central banker who watched the 2008 financial crisis detonate in slow motion and spent years afterward thinking about how sovereign balance sheets absorb shocks. He is sitting across from advisors who know that Canada's productivity problem is not about a lack of private capital in the abstract. It is about private capital refusing to absorb the political and regulatory risk of building things in Canada at scale. The Trans Mountain Pipeline taught them that. 15 years, billions in cost overruns. A federal government that eventually had to buy the asset outright just to get it finished. And then something interesting happened. Once it was finished and operational, Trans Mountain started generating approximately $10 per barrel in transportation fees on 1 million barrels a day. Run that math. That is $3.65 billion in annual revenue flowing back to Canadians, because Canadians own the pipe. Carney looked at that outcome and asked a different question. What if the ownership structure came first instead of last? What he didn't say out loud in that press conference, what nobody wrote in the first 24 hours of coverage, is that this fund is not primarily about the projects it invests in. It is about who captures the returns when those projects succeed. That is the psychological core of the announcement. And it is why the opposition's criticism, while politically understandable, fundamentally misreads what is being proposed. Receipt 1. Canada has a structural investment problem, and it predates Carney. According to the Spring Economic Update, tabled April 28, 2026, private sector economists project real GDP growth of just 1.1% this year and 1.9% next year. Business investment has been in structural decline relative to GDP for over a decade. The reason is not a shortage of money in Canada. Pension funds and institutional investors here manage trillions. The reason is risk-adjusted return. A Canadian pension fund can earn better risk-adjusted returns investing in U.S. infrastructure or European energy than in a Canadian LNG terminal that might take 12 years to permit. The Canada Strong Fund changes that calculus by absorbing first loss risk and providing co-investment capital that makes the project viable for the private sector to enter. That is not a handout. That is market design. But that is only part of it. Receipt 2. The competition is not abstract. It is active, funded, and already moving. The United States Department of Energy has committed to providing credit support of up to $44 billion US dollars for the Alaska LNG project, a direct competitor to proposed Canadian LNG terminals on the West Coast. Energy Secretary Chris Wright made that explicit. The U.S. government is not handing out money for ideological reasons. It is doing what every major energy exporter does. It is using sovereign capital to tilt the playing field toward its own producers. Norway did the same thing in the 1970s. The difference is that Norway's oil fund, as of April 2026, is valued at approximately $2.2 trillion USD. It now covers between 20 and 25% of Norway's entire public expenditures: healthcare, education, social services, built on royalty income from oil that a government decided 50 years ago not to simply hand to corporations and walk away. Think about our machinist in Windsor right now. She is not paying attention to LNG policy. She is paying attention to whether her grocery bill goes up again next month, whether her daughter's school has enough funding, whether the hospital in her city has enough nurses. Those things are funded by government revenues. Government revenues depend on whether Canada captures economic returns from its own resources, or whether it watches those returns flow south across the border while politicians argue about regulatory timelines. Receipt 3. The fund is being capitalized with borrowed money, and that is genuinely unusual. Brett House, a professor of economics at Columbia Business School, confirmed publicly that most sovereign wealth funds begin with surplus revenue, excess cash a government has accumulated. Canada does not have a surplus. Canada has a deficit of $66.9 billion in the fiscal year just ended. Champagne did not directly answer questions about where the $25 billion originates. What the government is doing is closer to what a development finance institution does, borrowing at sovereign rates, among the lowest available anywhere, and deploying that capital into equity positions that are expected to generate returns exceeding the borrowing cost. Whether that works depends entirely on the quality of the investments and the independence of the management. The CPP Investment Board, which manages over $600 billion in assets, is the proof of concept that Canada can structure these entities properly. The Alberta Heritage Fund, which has been rated repeatedly by consecutive provincial governments for short-term budget relief, and now sits at $31.9 billion after 50 years of existence, is the cautionary tale. Here is what every other outlet is missing: the retail investment product buried in the announcement. Carney said, and this received almost zero follow-up, that the government will create a mechanism for ordinary Canadians to invest their own money directly into the Canada Strong Fund and receive returns. Let me translate that for you. Right now, if you want to invest in the infrastructure that powers your country, your options are limited. You can buy shares in private companies that may or may not reflect Canadian assets. You can contribute to a pension fund that invests globally. What Carney is describing is something different, a product that lets a machinist in Windsor put $500 into a fund that owns a piece of a Canadian pipeline, or a critical minerals project, or a nuclear facility, and receive dividends when those assets generate revenue. That is not a liberal talking point. That is a structural change in who gets to participate in Canadian capitalism. It has never existed before at the federal level. The Assembly of First Nations noticed immediately that the details of Indigenous participation in that retail product and in the equity stakes generally are not yet defined. That gap is not a footnote. It is the most important unresolved question in the entire announcement. Drop your answer in the comments right now. Do you think the retail investment product actually gets built the way Carney described? Or does it quietly disappear in implementation? Here is what you are about to understand that has not been explained anywhere in the mainstream coverage. This announcement is not really about any individual project. It is about whether Canada builds a permanent institutional mechanism for compounding public wealth, or whether it remains a country that extracts resources, sells them at commodity prices, and then argues about how to divide the tax revenue. Those are two fundamentally different economic destinies, and the window to choose between them is narrower than most people realize. First analytical move. The governance structure is the whole game. The fund will operate at arm's length from government with an independent board and CEO. That is not bureaucratic detail. That is the single most important sentence in the entire backgrounder. Norway's government pension fund Global became what it is because politicians were structurally prevented from raiding it for short-term political purposes. Alberta's Heritage Fund became what it is because they weren't. In plain language, that means if future governments can access the Canada Strong Fund to plug budget holes, it will be worth nothing in 30 years. If they can't, it could be worth $2 trillion. Second analytical move. Carney is not just building a fund. He is building a counter-narrative to American economic nationalism. The U.S., under the current administration, has made industrial policy explicit: subsidies, tariffs, credit support for domestic producers. Canada has historically responded to that with multilateral trade arguments. Carney is responding with something different: sovereign capital deployed in competition. What that actually tells you is that Canada has decided the old playbook: wait for the WTO, trust the market. is not adequate for this decade. Third analytical move. Notice what Carney did not say. He did not announce specific projects. He did not name companies. He did not commit the fund to particular sectors beyond a general list. For a politician making an announcement this large, the absence of specifics is unusual. It suggests the fund's independence from political direction is not just a governance promise. It is being built into the announcement architecture itself. In plain language, that means he is trying to prevent the fund from becoming a patronage instrument before it even exists. Whether he succeeds depends on the legislation that follows. Columbia's Brett House notes that Canada's approach is unconventional precisely because it begins with debt rather than surplus. Moshe Lander, economist at Concordia, warned publicly that private equity investors will need guaranteed, targeted returns to choose Canada over U.S. tech opportunities, and that designing those guarantees without distorting the market is genuinely hard. The Caisse de dépôt et placement du Québec, managing over $400 billion in assets with a consistent focus on Quebec economic development, is the domestic model that analysts like Matt Ruffalo point to as the right template. And when both Bay Street economists and academic critics agree that governance structure will determine everything, you pay attention. To be fair to the opposition's position, Pierre Poilievre's central critique is not irrational. Countries typically build sovereign wealth funds from surplus, not debt. The $25 billion has to be borrowed. At current federal borrowing rates, that carries a real cost. If the fund's investments underperform, taxpayers absorb the loss while having received none of the private sector upside. And Poilievre is correct that regulatory burden, not a shortage of capital, is what killed most proposed Canadian pipelines over the past 15 years. The Canada Infrastructure Bank has existed since 2017, and its project pipeline has been far smaller than promised. There is a legitimate question about whether adding another investment vehicle solves a problem that is fundamentally about permitting timelines and political will, not capital availability. That is a serious argument. The pivot back, however, is structural. The Canada Infrastructure Bank provides loans. The Canada Strong Fund takes equity. Those are not the same instrument. Loans create repayment obligations for project developers. Equity creates shared ownership in outcomes. And shared ownership is what changes the political economy of project approval. Because once the federal government owns a stake, it has a direct financial incentive to see the project succeed. That changes the regulatory dynamic in ways that loan guarantees do not. For our machinist in Windsor, the next 30 days look roughly the same regardless of this announcement. Her grocery bill will be shaped by global supply chains, not a fund that hasn't yet made its first investment. Her mortgage rate will be shaped by Bank of Canada decisions, not a sovereign wealth document. That is the honest, short-term answer. But if you extend the timeline, 10 years, 20 years, the two scenarios diverge sharply. In the scenario where the Canada Strong Fund is governed well, makes disciplined investments, and compounds over 2 decades, it becomes a source of public revenue that reduces pressure on personal taxes and funds services that families like hers depend on. In the scenario where it is governed poorly, rated by short-term political pressures, or simply underfunded by future governments unwilling to maintain the initial commitment, it becomes a rounding error in Canadian fiscal history. The machinist never sees a dividend. Her daughter's school still faces budget pressure, and Canada is still having the same argument about pipelines in 2045 that it was having in 2015. Politically, this reshapes the domestic map in a specific way. It forces the Conservative opposition into an uncomfortable position, opposing a mechanism for Canadians to invest in their own country and share in the returns. Poilievre's framing, sovereign debt fund, liberal slush fund, is designed to preempt that dynamic. Whether it works depends on whether the retail investment product becomes real and whether ordinary Canadians can see their name attached to a return. Globally, the signal is unmistakable. Canada is telling institutional investors and foreign governments that it intends to compete for resource development on terms that resemble what Norway, Australia, and Gulf state funds have done, not on the terms of a jurisdiction that simply hopes private capital shows up voluntarily. But here is what this story is really about. It is not about this fund or this government. It is about whether Canada has the institutional patience to build something that takes 30 years to matter. That has never been Canada's political strong suit. The silence on the retail product details is louder than anything Carney said from that podium. If Canadians can genuinely invest alongside the government in nation-building assets and receive real returns, the political constituency for protecting the fund's independence becomes enormous. Every Canadian with money in that fund becomes a stakeholder in its long-term performance. That is not just an investment product. That is a political insurance policy against future governments raiding the corpus. If the retail product never materializes, if it gets delayed, redesigned, quietly shelved, then the fund remains an abstract government vehicle that most Canadians never interact with. And abstract government vehicles do not survive political cycles in this country. The Assembly of First Nations said publicly on April 28th that this path to building strong does not appear to involve First Nations. That is not a protest statement. That is a factual observation about what is missing from the document. Any major resource project in Canada that proceeds without meaningful Indigenous equity participation faces legal challenge and social license failure. If the fund's equity positions are built into projects that exclude Indigenous communities from ownership, the fund's investment thesis collapses at the permitting stage. That is the quiet technical problem underneath the headline. Watch three things. The legislation establishing the fund's Crown Corporation structure, expected before fall, will tell you whether the arm's-length governance is real or performative. The International Investment Conference Carney has announced for later this fall will tell you whether foreign institutional capital is willing to co-invest alongside the fund, which is the real test of its credibility. And the retail investment product. Watch for whether it appears before the next election cycle or after. If it appears before, Carney is serious. If it gets pushed past the next election, it was always a talking point. Each of those three moments is a binary. Either the governance holds or it doesn't. Either foreign capital shows up or it doesn't. Either ordinary Canadians get a stake or they don't. If this breakdown gave you something the headlines didn't, hit subscribe and turn on notifications. Because the legislation, the governance details, and the retail product announcement are all coming in the next 6 months. And that is where the real story either confirms itself or falls apart. Tell me in the comments. Do you think Canada has the political discipline to run a sovereign wealth fund the way Norway did? Or does it end up like Alberta's Heritage Fund? Two answers, both defensible, both matter.